Hey guys, Happy New Year. Now, in this video, we're going to talk about my investing plans in 2025 and how are we going to allocate capital, both in a tactical and strategic way. Well, tactical being short term, 3 to 6 months, strategic, we're talking more than a year period. And we are mostly going to be focused on the US market. We will briefly talk about, China, Europe, Canada, but this is mostly US based. And, even without getting too technical, I actually got rid of lots of things because it will be too long. But this is, as you can probably by looking at the list, you can guess that this is going to be a long video. Um, I don't know, about 2 hours. Not sure. I haven't done it yet. So as you can see, we are going to talk about lots of different things. Trump policies, bond, housing market, stock market, commodities, crypto, China. So this is going to be a long video. And to lay out my arguments, we are going to look at lots of charts and data, so you can have a better understanding of the reasoning behind my arguments and investing plans. And we're going to talk about their potential, what do you say, opportunities and their inherent risks. Because, with Trump being in the White House, you are going to probably see a lot of volatility in the market. So we are going to talk about the potential reward as well as the risk. Because, I've said this many times before. You do not have a portfolio of different stocks or bonds or crypto. You have a portfolio of risks, right? So the goal is to have a level of risk that you can tolerate, and then obviously be diversified so you can what do you say, increase your odds of success. So every chart has a point in the investment themes that I'm interested in. And, I'm sure I'm not going to be able to cover everything. And, if there are parts of the video that you probably find difficult to understand, or you need me to explain it more in depth, or you disagree, which is a possibility, you can always reach out, comment, and I'll try to cover it. Well, one last point before we jump in. I have, as you can see from the list, I have broken down the video into different sections. And, some sections are going to be longer than others because of, like I said, the level of importance that it has. For example, when we talk about the bond market, this is going to be a long one because, well, it affects everything. It's the cost of money. But anyway, I know that some sections might get more attention than others. But my suggestion is that do not look at each section in isolation and try to have a more holistic view. Like I said, each part of the markets that we're talking about has a role in your portfolio. So you got to take a look at it as a whole and weight that assets in your portfolio according to the level of risk that you can tolerate. And one more thing, uh, I don't like to do a lot of editing. So, like I said, this is a long video. So, if you hear me, I don't know, mispronounce the word or some mishaps, I apologize in advance. But I'll promise I will try to make the points that I'm trying to make as clear as possible. And I'm sure you are much more understanding than that. So, with that being said, let's begin. Okay. So, we're going to begin with Trump's policies. And these are the list of policies and promises that he's made. Uh, we're going to go through the ones that really matters to the market. And we can take away, the takeaway from his tax Okay, we're going to begin with Trump's policies. And I have a list of his policies, his promises so far. And there are three main takeaways from the policies. Number one is taxes. Number two is trade. Number three is immigration. We also have this energy policy, drill, baby, drill policy, but we'll get to that later. So, in terms of tax policies, as we can see, well, lower taxes for everybody, right? That's one of his policies, which is a good thing for the markets, right? Uh, mm, he had some tax policies in his first term that he is going that they are going to expire, and he's looking to extend those. But the part that really matters to the market is this one, the corporate taxes, which is going to be reduced from 21% to 15%. So that's for the taxes. That's a good thing for the market. And in terms of trade, which I have a slide after this one that I will show you in terms of what happens when you impose tariffs and you get into that trade wars, which we will get to in a minute. But his overall policy is going to be that he wants to impose 60% tariff on all imports from China. And later on, he said that he wants to put in an additional 10% tariff on all imports from China. So on China, who knows? It's going to be 70%, 100%, 200%. I don't know. Who knows? And but the important part is the Canada Mexico tariff, which is going to be 25%. And the thing about Canada and Mexico and the US is that they had a agreement called NAFTA, which he actually renegotiated NAFTA in his first term, and it's called NAFTA 2. So it's going to be really interesting to see how he's going to approach this again. Uh, and the consensus is always that tariffs are not going to be very positive for markets in terms of the market reactions, and I'll show you in the next slide in a minute. But the general consensus is that this is not a very positive thing for markets, but the tax cuts, excellent. Now, in terms of immigration, we have heard him say, during the whole campaign that he's going to deport so many people, so many, he called them illegal immigrants that he wants to deport. And this is also another thing that, the effects of it on markets is going to be, sort of mixed in terms of unemployment rate. And also in terms of construction, especially in terms of home buildings, and because a lot of the those construction works are done by immigrants, so that's a kind of wait and see kind of situation. And well, another policy that I haven't put it in here is that he wants to also lower regulation. So if you think of the themes that he has, lower taxes, good. Lower regulation, also good. Uh, in terms of trade and immigration, these two are, kind of mixed. We got to wait and see how much tariffs is he going to put, how many people is he going to actually deport, and when is he going to do that? Also the sequencing of it matters. When are we going? Is it going to happen a year from now or much sooner? So these are the things that we got to wait and see. But that's the consensus on these two, trade and immigration. Generally, we don't have a good consensus in terms of market reaction. But in terms of taxes and lowering regulation, well, those are positive points for markets. So kind of mixed so far. Now, in terms of energy, he has this famous quote that he said during the election. that he wants to focus on drill, baby, drill. So, but again, this is a huge question mark, because if you look at the oil production in the U.S. for the past few years, they have been drill, baby, drill. So it's a big question. How much further can they drill? And it really depends on the overall oil prices, commodity prices, because if first of all, if you have drill, baby, drill, then it's going to lower energy costs, which is a good thing in terms of the disinflationary process that we are already going through. But in terms of from the point of view of the oil companies, if the price of oil drops below a certain level, then it's not feasible for them to drill anymore. So again, that's a question. But I think we will talk about it in the section when we get to commodities, that there are certain areas of the oil market that will benefit from this, but the overall market, it's kind of still a question mark. But let's talk more about the trade and more specifically the market reactions that we're going to have, because one of the things about the putting on tariffs is that other countries are not just going to sit there and watch, right? You are going to have retaliatory reactions from other countries, and and again, we have seen this movie before. In his first term, he also had similar policies, higher tariffs on different countries, and this is kind of interesting to see. This is how during his first term, the tariff and trade war with China actually evolved. And you can see, and it doesn't matter what the tariffs are exactly. My point is that when you impose tariffs, you are going to have retaliatory effects. You impose tariffs on, I don't know, solar panels and washing machines. That was the famous one back in his first term. Then China also put on some tariff on other things like steel and aluminum tariffs and other products. So the point is that any kind of tariffs that you put on is going to be met with some sort of a retaliation. But how far will it go? And in terms of U.S. and China, well, these two countries, they really need each other. So we'll see if it's going to be resolved like in his first term or not. And the biggest thing that can China do to kind of combat this tariff effects is to China can allow to weaken the yuan, which look for this one to happen sooner rather than later. This is one of the things that can offset some of the tariff effects. Now on this side, I have the after each announcement, what was the market's reaction, right? And as you can see, it's generally having a negative effect, and the cumulative effect is about negative 11%. So, like I said, markets do not generally like this tariff wars and trade wars. All right. And another thing you should also keep in mind that China, just take a look at this chart. This is a beautiful chart. It shows the rare earth elements and production by country. Look at that. My God, look at that. So if you want to have that, and not only that, in terms of electronics, machinery and appliances, textile, clothing, metals, toys, mineral and chemicals, animals. But so, there are a lot of ways that they can play this, right? And if you want to have that future of a clean energy, the EV transition, all those kind of things, you are going to need a lot of those minerals, a lot of those rare earth elements. And what are they? Well, in China. And you can say China is the biggest factory in the world. So you either have to accept much higher prices for your day-to-day stuff, or get into some sort of an agreement, which they did last time. So that's about the overall Trump's policies and what he's going to do. Now, the other important thing is his pick for Treasury Secretary, which is Scott Bessent. And first, let me tell you a little bit about him. First of all, he is a very well respected person in Wall Street and in the world of finance. He is, known for being the Soros boy, George Soros. Him, actually, I'm sure you know who George Soros is, the guy who famously broke the Bank of England. And him, actually, and Scott Bessent and Stanley Druckenmiller, these two guys were the ones that actually were behind the planning for shorting the pound, the whole the currency thing. And George Soros was the guy with the that doubled down with huge sums of money and stuff. So anyway, he's the guy that is very well respected in the world of finance and in Wall Street, and a very knowledgeable guy. And when he became Trump's pick for Treasury Secretary, actually it was a calming effect in market, because there was a argument between him and what was it, the other guy, his name escapes me right now. But anyway, when he was announced that he's going to be Trump's pick, you could see that, especially in the bond market, it kind of came down, although it reversed most of its move. But anyway, I think he's a very good pick for that. Now, in terms of his agenda is called 3-3-3 approach, right? Meaning that he wants to cut the budget deficit to 3% of GDP. He wants to achieve 3% annual growth, and he wants to increase domestic oil production by 3 million barrels per day. So he's famous for that 3-3-3 approach. Now, in terms of cutting budget deficits to 3%, if you're interested to know what it is right now, it is somewhere around 6.3% of GDP right now. So he wants to cut it down to 3%. I don't know, about 900 billion. We'll see. We'll see. If anybody can do it, that's got to be him. But anyway, we'll see. And in terms of achieving the 3% annual growth, with the trade wars and that deportation, again, a lot of those things, because it's a new administration, so a lot of things you got to just wait to see how it's going to plan out. Not only how it's going to, which policies are going to take into effect, when. Like I said, the sequencing matters a lot. Is he going to, put a lot of things through executive order the first day in office, or is it going to take time? One thing we know about Trump is that he, says a lot of things, but then if he sees a bad reaction, especially in the markets, he's the kind of guy that's famous for backing off. So he changes his mind quite easily, and we have seen that. And with him, everybody knows you gotta bend the knee and kiss the ring. That's the kind of person he is, and if you do that, then he changes a lot of things. So we'll see. Anyway, there we are. So we talked about his policies, and he's picked for Treasury Secretary. And again, to recap this section, so in terms of, we can say in terms of tax, lower taxes, good for the market. Regulation, lower regulation, again, a good point for the market. In terms of tariffs, well, it's kind of a mixed situation. Immigration, also a mixed situation. So we gotta wait and see when it comes to these two. But these are going to be markets generally love. Obviously, everybody loves lower taxes and lower regulation. But again, a lot of wait and see situation, and you I promise you, you're gonna see a lot of volatility in the market, because that's how what Trump brings. In terms of I don't know, a 2 a.m. tweet from him that he thought about something. And by the way, I forgot to mention one more thing, which actually we will get to it when we are talking about the what is it in terms of the bond market and interest rate. I will mention it again, but it's not bad to also wrap this section with this. Also, he wants to have Donald Trump also wants to have a say in terms of Fed policies, and that's also going to be kind of a negative for the market, because everybody thinks of Fed as an independent body. But Trump being Trump, he's saying that nobody knows more than me. I know everything, and I can have some effect on the Fed policies, and that's also another thing. So, like I said, a very mixed picture, and we have to wait and see what happens. All right, let's move on to the bond market and fixed income. Okay, so let's talk about the fixed income and the bonds portion of the portfolio. And here I would like to talk about mostly about the longer duration bonds, end of the back end of the treasury curve. And if you think of, and I think this year is going to be a very good year for the bond market in terms of total return, something that we haven't seen for quite some time, and it was not a very good investment for quite some time. But I think next year is going to be a good year in terms of not only getting the yield, but also getting some price appreciation as well. Now, if you think of how bonds are priced, generally they are priced in terms of GDP growth and inflation and term premium. So these are the factors that you consider as a bond investor. What is the GDP growth situation? What is the inflation situation? And you have some term premium. And I think markets are wrong in terms of all of them at the moment. Well, I don't really have a problem with term premium, but in terms of GDP growth and inflation, like I say here, markets are too optimistic about growth and unemployment and very pessimistic about inflation, meaning that they think inflation is going to be, get out of hand and go up a lot. And we are going to take a look at all of them, and I'm going to lay out my argument to you. But, generally, thinking that Trump's policies are going to affect inflation a whole lot, which it might, but not to the extent that the market thinks. And in terms of growth, it's not like I'm calling for a recession or anything. No, but, I don't think that trend is going to continue. And I have my doubts about unemployment. But before we get to those things, let's take a look at the interest rates and how it has evolved. The latest cut by 25 basis point brought us to 4.5. So as you can see, we had a huge hike in interest rates, after the pandemic, and then they held for a while at 5.5, and now we have 100 basis points, almost, not almost exactly 100 basis points of cuts. We started with in September with a 50 basis points jumbo cut, which I think that was wrong, but 25 basis point would do. But here we are. And then we added another two more 25 basis points, which brought us to 4.5. And, interest rates are in a range. So we are 4.25 to 4.5. And if you take a look at the effective federal funds rate, that's 4.3. So, but, the interesting part about this cycle is that, this cutting regime cycle, which I think it will continue, by the way, is that you know, I, although we had a 100 basis point cut, but something very strange and I might say unique happened in terms of the bond market, in terms of the capital market, like 10-year yield, right? Which I will show you right now. Now, this is called the yield curve, and we are going to focus on the 10-year yield. The green line is a year ago. How did the curve look like a year ago? And the blue line is right now. Now, as you can see, we had a inverted curve for quite some time. You know, the from a year to this. So this is called the money market yields, and these are the capital market yields. And as you can see, for quite some time, the money market yields, the shorter term bills, were a lot higher than the 10-year and the back end of the curve, which gave us an inverted curve. But now we are going back to that normal curve again. But the interesting part is that this is 10-year a year ago, right? So since a year ago until now, we had 100 basis point of rate cuts, correct? But look at this. The 10-year yield went up in the opposite direction, almost by 100 basis point as well. So that's what I mean by the unique part, which is kind of strange. And again, the reason that this is happening is because the market is thinking that we are going to have growth is going to be off the charts, and no unemployment, and also inflation is going to come back, which I agree with some part of it, but I think it's too much. So my investment thesis in terms of the bond portion of the portfolio is that I believe that the yields are going to come down, uh, most probably back to where they were about a year ago. So right now we have 10-year yield, call it at about 4.55, something like that. And right here we had it about 3.89, something like that. So I think the yields are going to drop at least to that level, but this is where the market is right now. And the Fed also didn't do this move any favor, actually. Uh, Let me show you the dot plot from the SEP. This is a dot plot that comes from the SEP, the Summary of Economic Projections, which is published by the FOMC 4 times a year. And this is the dot plot, which the policymakers they come up with their own projections of where the rates are going to be in the 2025, 2026, and the blue line, as you can see, is called the median dot. So where the majority of the policymakers think that the rate should be. So right now we are at, like I said, 4.5, and the effective rate is 4.3. And the interesting thing is that in their last SEP, they were projecting to have 4 cuts in 2025. But in this one, they are projecting 2 cuts. So number of cuts have been reduced by 2 cuts. And even the market, is that when you look at the futures, Fed funds futures, they are even, estimating less than even 2 cuts. They're in like, I don't know, 1.5 cuts, something like that, which I think is wrong. I think we are going to get that 4 cuts, at least 3 cuts. That's my estimate. And the reason that this happened is that because in their projection, they have revised GDP higher, and also they have revised inflation higher. And the reason for this move was that they have models that they take a look at, and they put some of Trump's policies into those models, and they are which again, it's very odd. I mean, he hasn't come into the office yet, and he hasn't, implemented any of those policies yet, and we don't know which policies are we going to get, which we are not, and when. So it's kind of odd for me that they have already done that, and to me they are becoming very, very data dependent, and that's why they're creating some unnecessary volatility in the market. So they have to, of course, they have to have that in the back of their mind, which they had during his first term also, that they went through the same process, but they waited for him to implement some tariffs to see what the effects are, and then they changed according to those policy changes. But right now, nothing happened. And I think Chair Powell said something to the effect that future is like walking in a dark room full of furniture, something like that. But anyway, that's where we are. And when you're going to have 4 cuts, then you reduce it to 2 cuts, and the market goes for 1.5 cut. What do you think the effects in the market is going to be? The stock market, the risk assets in general, they want more cuts. They want lower interest rates. So when you tell them that you will probably not give it to them, what do you think the market reaction is going to be? This is called the VIX, right? Which is the volatility index for the S&P 500. And, it measures the number of puts in the option market that, they're buying against their position to, because they're afraid of the any correction or downward move. So the demand for buying put options goes up, and that in turn brings the VIX high. This is at the time of the announcement of that dot plot, and the VIX went up to about 30. What do you think happens to the market when the VIX goes up to 30? There you go. That's the market that you get. Red, 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 everywhere, right? So like I said, markets do not like being told that we are not going to have a lot of rate cuts and lower interest rate. But again, some of this move was reversed back up. And the reason for that is that because, they think, okay, a lower rate, but we're going to get higher growth. So that should balance itself out. And again, my argument is that, in terms of GDP and inflation, market is too optimistic about one and too pessimistic about the other. And let me explain to you, let me start by explaining my, argument with inflation. This is the chart of CPI and PCE. And the orange one is the CPI. And, we know the difference between CPI and PCE. And PCE is the one that the Fed looks at, actually. So as you can see, that CPI and PCE, both of them, after it went up, after the pandemic and all those inflationary process, it went down almost as fast as it went up. And yeah, sure, the rate hikes actually had its effect, but I think mostly it went down because, we had a pandemic. The whole world was shut down. That's a big deal. All the supply chain and everything was disrupted. So as those supply chain went back to normal, we could see the effect being reversed. And one thing that we should never forget is that before this inflationary regime happened, we were, most of the developed world, they were dealing with deflation, not inflation, right? And this was a unique time. And the reason for it was that because the supply chain were disrupted. So, and government gave people money and they couldn't go watch a movie or to cinema, or they couldn't use that money to go on a trip or something. So what did they do? They bought goods. And when you have supply chain that are disrupted, the demand that is chasing after the same good is going to be a lot more than the good itself. So that's why you get inflation. Now we are seeing that that trend is being reversed. Although the higher rates might have some effect, but I think that's mostly the scenario. And I think that's going to continue. And not only that, technology and the whole AI wave that is coming, these are all disinflationary forces. And I agree that we might have, a sticky situation here. So we might stay here for a while. But again, the trend, uh, sometimes you have to zoom out and look at the trend. Trend is going down. And obviously, the line that they are trying to get to is a 2%. And right now, CPI 2.7, PCE 2.4. So we are almost there, actually. I mean, forget about the core, which we take out the food and energy. I mean, I can't say forget about them, but and these are actually important. But even those, if you take a look at the core CPI and core PCE, also trending down. I mean, the only thing that I can see that might disrupt this disinflationary flow is that we get an energy shock, well, which is always a possibility, but not very likely. So, and even regarding those tariffs, and we have seen it in his first term, tariffs generally have a one-time bump in inflation, and but it's not it's not consistent inflation. So you get a one-time bump, and then you take it from there. So again, my view is that this inflationary process is going to continue. Thus, the 10-year yield is too high. And I might add that in terms of the housing market, which we will get to later, actually these higher rates are causing more problems that they're solving, which I will talk about later. But anyway, in terms of inflation component of the bond market, I think they're wrong, and I think this inflationary process continues. That's why we have to get. I think we got to get more cuts and lower yields. Now let's get to the GDP part. And when you take a look at the GDP, this is quarter the GDP growth, and this is real, by the way, real GDP growth. And look at that: 2.7, 3.4, 2.8, 2.4, 4.4, 3. My God, this is like exceptional economy, right? Agreed. No arguing that, right? But the thing is that, will this trend continue? Which I think that we are going to moderate this rate. And not only this, and if you take a look at the Atlanta Fed GDP now, estimates, they think that it's going to be around 3.1. It's going to average about 3.1. But like I said, and this trend line changes all the time. So I am expecting a more like an inline kind of GDP growth. Again, I'm not calling for any recession or anything, but the way the bond market is pricing in the GDP growth rate, I think that's too much. And with the the whole trade war and the deportation and all those kind, I think it's it's a not a very clear picture. And I'm calling for more moderation in GDP and inflation, disinflation process. And even if we get this, before we continue with this, see, this growth in GDP is mostly in terms of services part of the economy, and lots of government deficit that is responsible for this growth. And we know with the Doge and government efficiency that Elon Musk and Vivek Ramaswamy is going to have. So are we going to have that much government deficit spending that's going to boost the growth? Oh, we'll see. That's another reason that I think that. But again, this is mostly a service-based economy. And if you take a look at this, this is ISM PMI. And if you take a look at this, and this is a diffusion index, by the way, meaning that anything above 50, we are expanding, anything below 50, we are contracting. And as you can see, this is when it comes to the manufacturing index, this is not a pretty picture. So we are mostly seeing that in terms of services. This is another reason that I think that sustaining that GDP growth, I have my doubts, which again, it's all about your balance between risk and reward, right? So in terms of risk and reward, I call for that, it's worth it to take that risk in terms of the bond yield, because the downside, I think, it's very limited relative to the upside. Uh, Now, even if we get that GDP growth that we were talking about, still, I don't think it's going to have inflationary effect. Why? Take a look at this. This is this blue line is hours worked, and the purple line, it's not purple, is it? What color is this? Purple line, I think it's purple, is the output, and the red line is productivity. So take a look at this. You have your hours worked hasn't changed much, but your output is going higher and higher and higher. So what are you going to get? You're going to get labor productivity, right? So that's the reason that I think that you're not gonna get that inflationary effects out of the growth, because the whole country is becoming more productive with the use of technology and everything. So even if that GDP's growth is, let's say it's going to be achieved, it is not going to be inflationary. It's not, the economy is not going to get too hot, so to say, because we are seeing a lot of productivity that is not going to put any too much pressure in terms of inflation. Now, let's take a look at unemployment rate also. This is the unemployment rate, which is right around 4.2 at the moment, and this is relatively very low unemployment rate. But and right around this area, we had in the summer, we had like a scare that, oh, unemployment was going to go up, and so, and I actually argue that this, although this unemployment rate is low, the most hiring, when you break down the jobs report, most hirings are done by government. So, like I showed you, when it comes to the manufacturing sector of the economy, that's not a pretty picture. And if you want to deport lots of people, and that's going to have some effect on the businesses that they use them to increase their output. Again, that's a question mark. So I am I'm kind of skeptic of this. I'm not really comfortable with unemployment right now. I think, uh, again, like everything else, I'm not calling for a crazy recessionary unemployment to the roof kind of thing. But like I said, too much optimism in this area. That's my problem, and that's what creates that opportunity in terms of bond yields for me. Anyway, so this is my argument in terms of the rates and the inflation rates, GDP, and also in terms of whether the Fed is going to have 4 cuts, 2 cuts. And one thing, let me just bring this one back again. The interest rate, right around this area. This was Trump's first term, 2017 to 2021. So this was his first term, and during this time, also forget about this part, that the pandemic hit, that they had to cut rate, emergency cuts and stuff. So after Trump was elected, around in 2018 or so, he started to have the tariff proposals and stuff, and then the tariff war, the trade war happened. So the Fed started to hike rates. And interestingly, we have the same president and the same Fed chair. And even at that time, right around this area, Trump tweeted, forget about what the tweet is. We're not going to read it. It's just that he was criticizing the Fed for hiking interest rates, right? So he always, like I said, we have seen this movie before. He gets into fight with everybody, and if somebody does something that he doesn't like, he's going to criticize it and he's going to broadcast it. So one of the other things that I think that we are going to get more cuts in 2025 is that dynamic between Donald Trump and the Fed chair. And he has said it already. He doesn't like Jay Powell. Donald Trump doesn't like him. So we'll see how it evolves. But I'm pretty sure that he's not going to stay quiet. Is what I'm trying to say. So in terms of inflation, I think because we are going to get lower rates, the yield should come down. Because GDP is going to moderate, the yield should come down. And in terms of the interest rates, I think because of the dynamic that Trump has with Chair Powell, again, I think that's going to. And I saw this one posted somewhere, which was very funny to me. So I thought I'd put it in there. So this dynamic is going to continue, and if Trump doesn't get his way, I'm pretty sure he's going to blame everything on Powell, and he's going to call him names. He's going to ruin his day. And not only this, this time we are. This is also an interesting picture, and this picture was not photoshopped or anything. This was just a great moment that was captured by the photographer. So we have also this guy added to the mix with his, the Department of, this is spelled out, Department of Government Efficiency, Doge. We'll get to that when we start talking about crypto market. So he's also going to be involved, and we have already seen him started tweeting, that the Fed is overstaffed, so he wants to fire some people there. So the dynamic between him and Trump, arguing with Powell, and both of them, they really rather have lower rates, and also, other than interfering with the Fed, the presence of Scott Bessent, I think it's and the way he's going to use the yield curve to finance governments instead of using the shorter term bonds going to the back end of the yield to finance the government deficits and stuff. And like I said, I think he's a very well respected and knowledgeable person. So putting all that pictures together, I think like lower yields are expected in the future, and I am going to be positioned for that. And how I'm going to get exposure, there are many different ways to get exposure. One of the ways to get exposure is through TLT, which is the 20 plus year treasury bonds, which is a good entry right now, I think. And not only this one, you can use ZB, which is the futures contract, to get that done. And there are other ways to do it, but these are the most, you can get the direct exposure, or you can go and buy the bond directly. But these are other ways that I prefer to do it rather than owning the 10-year bond directly. I rather do it through the ETFs or the futures mostly. And if you know how to use the options market, this is the volatility of the TLT. And if you know how to use that, you can, even if it goes against you, there are many ways to, to manage your risk and get better exposure. And with the implied volatility being high, and there was at some point that was really funny to me. At some point, the volatility of the bond market was even higher than the S&P. Just crazy. It's like, you're talking about risky stocks and government bonds. Well, are you saying government bonds are more risky? It's just anyway. But these are all good opportunities to, again, if it goes against you, to minimize your risk, sell some calls, double the yield, stuff like that. So that's my argument in terms of the fixed income and the bond portion of the portfolio. Now let's move on to the housing market, which is very closely related to the discussion that we just had regarding the 10-year yield specifically. And we are going to talk about, the whole state of the housing market as a whole. And we are also going to talk about home builders and residential real estate investment trust. Okay. So let's revisit this whole yield curve again. And like I said, this is a year ago, this is a month ago, and this is currently, right? And the thing about the yield curve is that although we talk about interest rates being 4.5, 4.3, the effective rate, but nobody, gets that rate in terms of consumers, right? Consumers should care about the 5-year, 10-year, and 30-year. Now, why these three yields? Well, if you're getting a car loan, you are mostly pegged to this rate, the 5-year yield. If you're getting a mortgage on your house, you're mostly pegged to that 10-year yield. And depending on the type of mortgage, 30 or 10-year. So when when the yield on the 10-year goes up or on the 5-year goes up, this is going to affect, because it's the cost of money, right? It's the cost of money. So it's going to make mortgages more expensive. It's going to make every loan that you get more expensive, right? So this is one of the reasons that I'm saying that I think in order to solve that housing problem, they have to also solve some of these yield issues. Otherwise, you're not going to get you're not going to solve those areas. And let's take a look at a few datas from the housing market, which you can see because of this elevated yield, they're not having a good time right now. This is the mortgage, the 30-year fixed and 15-year. And as you can see, because like I said, these are pegged to the 10-year and 30-year. So when those yields hike, they go up as well. So right now we are almost getting to the heights of 7-something%. This is an expensive loan, expensive mortgage to have. And a lot of people are expecting that the because the interest rate is coming down, so the yields also come down at some point, which again, I am from of the belief that it will. But right now it's not a pretty picture. So that's a very expensive mortgage to have. Now, the effects that it has on also, the number of unsold finished new homes, as you can see, it's going up, meaning that the home builders, they have a tough time of selling their house, and the inventory level is going up. And when you go through the the financial statements of most of the home builders, one thing that they point out is actually higher rates. They are saying that it's causing people to back off. And we can see it in terms of the inventory level that is going up. Now, there are a few other charts that we're going to go through them quickly, but you can see all of them are trending down. So this is the existing home sales, down. The new home sales, oh, you can call it a sideway market. Building permits, also down, obviously. Housing starts, also down. And, I should mention that something, by the way, because, like about a year ago, year and a half, home builders, they had like the best time of their life, in terms of the stock market, because first of all, the yield was not that high, and because a lot of the supply was locked, because whoever got I think I read it somewhere, I don't remember where, it's like about 70, 60, 70% majority, let's call it, because I don't remember, majority of those that they have mortgage under 3%. So that actually caused a bit of a trouble that for them, and they didn't want to get out of that 3% mortgage, so they sat on their house, and if they were planning on upgrading, moving to another one, because if they do, then they had to get a mortgage with a much higher rate, so they did not get out of that house, and that created a good scenario for the home builders, because not enough supply, so you got to get get that supply from the home builders. But now the situation has changed. When you have persistent long-term yields being on that level, then that changes things. That's the thing. If you have a spike for a month or two, that may not have an effect, but this has been going on for a long time, and that is going to break some things. Anyway, let's take a look at the also the housing market index, which again, all of them are saying the same thing. In other words, that the housing market is tight, and these rates, these mortgages are making it difficult for people to start buying. But again, if if you have the belief that I have, that 10-year yield should not be where it is, then you should also have some positive view in terms of the housing market, which I think well, housing is quite different, and these are the things that you got to give it some time to correct. But I think in terms of housing also, because of the yield that is going to come down, and also because of some other thing that I'll get to, it's a good start, I can say, to have some to begin positioning yourself, not full position, but beginning to. Now, another reason that I think housing and the home builders in general having it's a good opportunity to start building up position is that especially in Canada, by the way, but in US as well, there is a house shortage. If you take a look at the US market or the Canadian market, we are having a short, and these shortages that they say 3.1 to 3.5 million in Canada or 4.5 million homes in the US, these are the numbers that they need just to bring the market back into like a balanced level, not to oversupply, just to bring it to balance. This is the amount that they need, right? So again, regarding the housing market, I am starting my position in the housing market, and the reason is that number one, I think the rates are going to come down. Number two is that this is the strategic view that I have, that we are having a shortage, and that by itself will no matter where the yields happen to be, if you need a house, you need a house, right? And a lot of them, and the other reason that I said that I'm mostly in home builders, I'm starting my position, but in terms of the residential REITs, those are the ones that I have my full positions on, because a lot of them are built to rent, and if you can't buy a house, you're going to rent a house, right? And we see that the rents are not coming down as fast also. So again, that's my view in terms of the housing. And when you take a look at the housing construction ETF, you can see that it's been coming down again, obviously because of the rate situation. And I think you can see some sort of a uh, resistance level, support, I'm sorry, a support level right around 100 line in terms of the ETF I'm talking about. But, when it comes to the home builders, I don't like the ETF. Generally, I'm just showing it to just present and make my point. But I prefer to have like DHI, which is, and also the L and Lennar and DR Horton. These two are the big guys in the US. So I prefer to be in them. And also in terms of Canadian market, there I'm not touching any of the home builders, but in terms of the REITs, residential REITs specifically, not office REITs. No. Just residential REITs, and there are a lot of them. When you take a look at them and you look at their book value per share, all of them, without exception, are trading below their book value per share. So what does that tell you? I think that's a very good opportunity to get into those areas right now. In terms of home builders, I think it's a right place to start building your position, not full position, but slowly building your portfolio. All right, moving on to the stock markets. And again, here we're going to talk about the stock market as a whole, large cap, small cap. And then we're going to talk about healthcare, the AI build out, cybersecurity, banks, and insurance in specific. So let's begin with the S&P 500. That's the index, and as you can see, a good run, very good run, right? And it's recently it has some towards the end of the year. It had some volatility. Uh, but my view in terms of the stock market in general, as you can see, the forward 4-quarter PE is about 23. Well, depending on where you get your earnings from, but it's around 22 to 23, right? That's an expensive market, right? And I'm not really comfortable with that level, that high level of PE. And this is forward PE. When you look at the trailing PE, it's more like, I don't know, 25, something like that. So that's an expensive market. And we know that most of this move is being done by just a handful of names. So I'm not really comfortable with that either. Now, to just show you what I mean when I say the PE is quite high, is that take a look at this. This line represents like the average PE level for the S&P, which is around 17. So as you can see, we are that's again that's an expensive market. I don't think that 17 really represents the technology based stock market that we have today. This is also too low, I think. But 22, 23, it's an expensive market. That does not mean that you got to short this market. No, 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 no. I don't believe that deserves to be short this market. And there are pockets of the market that I like, but the overall market, there are easier fights to win. It's what I'm trying to say. Now another thing that you can take a look at, which is called stock price breadth, and this is the explanation of it. But the gist of it is that this is the volume of the shares that are going up against the ones that are coming down. And as you can see, this is trending down. That means that the market is being held by only a handful of names. So the whole market is not really participating. It's not really pushing the market up as a whole. So that also creates. And by the way, this as much as I'm not comfortable with the index as a whole, this represents a good opportunity for the equal index. So S&P 500 is a market cap index, but you have RSP, which is the equal weighted index. That I'm on board with that, but not the S&P 500. And this is also another way of saying, this is from Bank of America, another way of saying that how many percent of companies outperforming the S&P 500, right? So in 2024, only 31% of the stocks actually outperformed the index as a whole, right? Now, this, I think I got it from Apollo, and this is very interesting chart. Now, on the x-axis, you have the forward PE, and on the this y-axis, you have the annuals, 3-year annualized return, right? So what this is saying is that as the PE goes higher, when we go above, let's say, 20, right? And this dotted line presents the annualized return, implied annualized return. It comes down, which is understandable as the PE goes up. It's normally sound of a top kind of thing rather than being a low. But if you have a market with a low PE, then your potential return is 20%, 30%, 40%, right? But as you go above 2020, and right now we are somewhere here. So this is the range of outcomes, and the implied range of outcomes is somewhere 2.9% return over the next 3 years. right? So again, I'm not saying, shorting the market or anything. No, but I'm saying there are easier fights to win, and there are parts of the market that are going to benefit, in my opinion, regardless of the cycle and the government policies that we have, which we will get to later. So, and this was the we were talking about large cap so far. This is the Russell 2000, which is the small cap, and they had a relatively tough, bad few months. But generally, small caps are something that I stay away from them altogether for now. For now, until we get a better picture in terms of the 10-year yield, because that yield is going to affect everything, right? Especially the companies with more debt, which is my next slide is about. And that's, I think I got this one from Apollo as well. And I want to direct your attention to the floating, which is the dark green part. This is S&P 500 and this is Russell. The S&P 500 companies, on average, they have about 24.2% of their debt is floating, right? But when you take a look at Russell, that number is more than half, right? Meaning that all these debt that they're holding, that probably they got them at a lower rate, now they have to refinance them at this higher rate. So what do you think that's going to do to their profitability? And one other thing that you should keep in mind is that a large portion of the Russell 2000 companies are unprofitable, right? So put that on top of the floating debt that they have. But again, uh, there is a specific time to be long the small caps, and that's generally when an economy is coming out of a recession. So it's starting the expansionary process. That's the time that they shine most of the time. But right now, depending on the yield that we are going to get, and some of the policies of the Trump administration has to work out amazingly. Otherwise, again, I repeat this one many times, and I'm going to repeat it again and again. There are easier fights to win, right? So I want to talk about the bank and insurance, and for that we need to revisit the yield curve again. Do you see this shape? This shape? This is called a normal yield curve, meaning the longer duration bonds are higher than the shorter durations, right? T-bills and stuff. This is called the normal curve, and this is nirvana for the banking sector, for the insurance sector specifically, because think about it. What do banks do? They borrow on the short end of the curve, and then they lend it out on the long end of the curve, right? So that's why, and the difference is what they pocket, right? So this environment is nirvana for banks and also insurance, because this yields being so high. And remember, some people forget that for the past, I don't know, if you forget about the past couple of years. Before that, we had yields, I don't know, about 1%, 1.5%, something like that. Right now, you get like 4.5% on the 10-year, right? So that's something that creates good opportunity in the insurance specifically, and this is the insurance ETF. Uh, it had some correction as of late, but I think that creates a good opportunity for entry here. And this is, if you want to talk about the ETF, that's the ETF. But I like, for example, when we're talking about insurance company like Chubb, I like that. I like MetLife. I like Progressive. These are the names that I like in a specific way. So I would probably go for them rather than the ETF, but that's again another way to have exposure to that industry. And in terms of the banking sector, this is again an ETF for the banking sector, and they have been having a good time. And this past a few days or so is mostly because of the volatility at the end of the year. But again, you can get your exposure through the ETF, or I prefer mostly big banks, obviously, like J.P. Morgan, Goldman Sachs, and Citi. These are my favorite in terms of the banking sector. All right, moving on to the healthcare. Now, the reason that I'm very interested in the healthcare sector is that, look at this, structural demand in healthcare sector driven by aging population combined with rapid innovation in medical technology drug. So again, this is a very good slide picture to see that the demographic trends. And the thing that we have to take away from this is that the population is aging. So as people age, you're gonna need more healthcare. You're gonna spend more money on healthcare, and this is also another good chart to do that. So this is the percentage of healthcare spending as a percentage of GDP, and we see that in US is quite high. So a global population is shrinking, the population is aging. That is one of the strategic views that I have in terms of the healthcare sector. That is, like I said, regardless who is in the White House, that's something that is going to be beneficial to the healthcare companies, right? And although in Trump's new term, they talk about this, what was his name, RFK, Robert Kennedy Jr., that he is like an anti-vax and he wants to destroy this healthcare. I think that's a hype, and it's going to go away because a lot of these companies, they have a science-based approach. Yeah, of course, some of them, these are corporations. Of course, some of them are not that healthy, but in general, there are companies like that I like in this sector a lot, like Pfizer. What else? Eli Lilly, which I will get to in the next slide. Merck, Biogen. So a lot of these things are working on number of pills, Alzheimer diseases, that's very beneficial, and it's going to, I think, take advantage of, regardless whatever the environment is. Okay. Now, another thing that is going for the healthcare sector is the GLP-1 revolution, which is, we have Novo Nordisk and in Europe, and also Eli Lilly in the US, that they have, I think, what is it? Is it Novo Nordisk has this Wegovy, and Eli Lilly has the one that is Zepbound, which is causing a huge revolution in terms of the weight loss. And not only weight loss, it seems that they have done a lot of research that it shows that not only in terms of the weight loss, in terms of alcohol addiction, all sort of things is going to have its effect. And this is something that you talk about weight loss in the US, even internationally, people are going to pay for that. And no matter how you price it, if it works, they're going to pay for. And we have seen a lot of studies being done, and it is reducing the weight by quite a margin, but it has some issues in terms of muscle mass that is also affecting. But overall, this is the best way to so far to reduce the weight. And I think it's the wave of GLP-1 medication is going to continue the way it has so far. So this is also another thing that is going for the healthcare sector. And Eli Lilly is what is it, is on the front line of this revolution. Now let's take a look at the healthcare sector ETF. And as you can see, it's not a pretty picture. Well, few reasons for that. Number one, after we came out of the pandemic, people realized that they don't need the vaccines that is coming out as much. So before the pandemic ends, everybody was estimating that the use of this vaccine was going to be double, triple. So the projections, a lot of those estimates, future estimates, came down. So that's number one. Number two, the other thing that after, especially for this past few months, that it was becoming it was becoming clearer that Trump is going to become the president, and he was talking about Robert Kennedy Jr. He is going to be in charge of the healthcare, so that also played some part in terms of undervaluing these companies. Another reason for it was that generally in the presidential election years, because healthcare is a good talking point. Oh, I'm gonna cut healthcare. I'm gonna do that. I'm gonna do that. So that also generally you will see this trend in the presidential election years all the time. Anyway, I think all of that good. That creates opportunity, and again, we can see a nice support level around this area. I'm not very comfortable with indexes in general. So, like I said, there are companies within those that I like Eli Lilly, AstraZeneca in the UK, Novo Nordisk, what is it, Merck, Biogen. So, Pfizer. These are the things that I like the most. All right, moving on to our next theme, which is the AI wave and the AI revolution. And this is going to be one of those that is part of my tactical part of the portfolio. I'll explain why. First, let's get to this chart, which is really interesting. It talks about the infrastructure build out and the beneficiaries of the AI. And the reason I say it's tactical, because the areas that I like to be in, I think they have, after we're talking about a year or so, then again, we got to wait and see. But for the next year, I think the build out still continues. But after that, at some point, you complete the process of the build out, right? Like the internet wave that came, they had to put on all the fibers, the wires, everything. But at some point, it ended, right? So now, when we are talking about the beneficiaries of AI, so we have the users, then we have the software providers, the compute providers. We have the Google, Amazon with the cloud, Microsoft with also the cloud, and everything else. Google with the search, Gemini. So these are the areas that you can see benefit from the AI wave, but they are not in the forefront right now, for me at least, because we're still in the build out phase. So these are going to be a lot more useful when we are finished with the build out. But the part that are interesting to me right now is the semiconductor part and the power part. These two areas are the areas that I'm interested in the most. In terms of semiconductors, we have companies that are designing the less advanced chips, and we have the ones that are designing, not making, just designing the chip. And the master of them, the godfather of them, is NVIDIA, right? We have also AMD, also with a close competition with NVIDIA, but NVIDIA and Broadcom are the main ones. But in terms of the less designing less advanced chips and memory, here we have Micron that I'm interested in, because all the chips that you are making, you are going to use the memory in it, regardless of who is the winner in terms of the chip design. So memory is an area that I'm really interested in, and Micron is the by far the best one here. And they have not had a good year, I can tell you, mostly because of the PC laptop base part of the company that is not doing great. But I think they will recover. Anyway, here we got Micron, here we got NVIDIA, AMD, Broadcom. Now, in terms of chip production, here we have TSMC, TSMC, which is Taiwan Semi, which is I can say they have the monopoly in chip manufacturing, right? And they are, I obviously from the name it's clear they are in Taiwan, but they have this geopolitical risk with China. So anyway, but they have monopoly in terms of chip production. And in terms of chip manufacturing equipments, we got ASML, which another company that I'm really interested in. Now, all of these things that we're talking about, with the AI and everything, and I will explain it more in my following slides, but I will give you a preview. They need lots and lots and lots of power. So that's why another big theme of mine is utilities, right? Which I will explain in the next slide. So, like I said, technology is a power hungry, beast, you can say. And this shows the growth in terms of the demand growth in terms of data center power use, right? And what's interesting about this chart is that this part shows that the data center power X AI, so we take the AI part out of it. This is when we add the AI. And remember, this whole AI phase just begun. So it's not something that this is probably not a very clear picture. Although we are estimating up to 2030 what it looks like, but again, most of these are estimates. I am from of the belief that it's going to take much more power. So whatever projections that we have up to this point, look at this. Even with the projection, let's take the projections as a baseline. Forget about everything else. As as the projection indicates, this is where we are. This is where we could be, by 2030. So as you can see, it's a power hungry thing, technology. This is another chart by Goldman Sachs. Again, we are saying the same thing in different chart. And the story is that technology, AI, power, utilities, right? So that's the whole idea. Now, we went through the AI build out, the chips and the utility power dynamics and that we need. So those are our big investment themes. But with AI also comes a lot of security risk, cyber security risk. So if you believe that wave of AI is going to continue, then you have to believe that the cybersecurity threats are only going to get bigger, right? So that's why our next theme is cybersecurity in the age of AI. And this is the ETF for the cybersecurity. And again, just like the other things, I show the ETF just to show you the overall segment and how it's doing. But this is one of those things that I think gonna explode in the next few years. And for me, the companies that, especially when it comes to cybersecurity, if you want to hire a company to provide you the security services, the bigger that company is, the better for you. So it can cover all the aspects of your security. That's why, for me, the big companies like Palo Alto Networks is like a winner for me, because they're having, from the cloud to other things, they're big everywhere in terms of the number of products that they have. After Palo Alto, you have Fortinet, you have CrowdStrike. Even though CrowdStrike had a lot of problems with the airline issue that they had, but still, I think people are going to forget about that. So lots of opportunity in this space as well. Great, wonderful. Now let's go move on to commodities. And we're going to talk about copper, gold, natural gas. And in terms of oil, we are going to focus on oil services and energy infrastructure MLPs. Now, before we discuss those, I should mention that the risk for in terms of commodities is the US dollar, right? Because all of the commodities, the major ones, are all denominated in dollar. So a higher dollar can, affect the prices of them. So they have an inverse relationship. Higher dollar, lower commodity prices, because it has to remain the same in other currencies. That's why when the dollar goes up, to keep that price stable in other currencies, the price of the commodities will drop. So that's the risk. And boy, oh boy, dollar has been on a tear for the past few months, you can say. And again, this is also something that we saw the same pattern in the Trump's first term, with the same dollar surge, and then we had other things that adjusted for that. But anyway, when we're talking about commodities, always watch the dollar index. Now, let's talk about copper first of all. And you know, if you believe that AI wave, if you believe that technology wave, and if you believe in the EV transition, in that future, in that digital future, it cannot happen simply without copper, right? So if you believe in that digital future, copper, anything that you need to move in electrons in it, you gotta need copper, and that's the most efficient way to do that. And so that's why, again, this is part of my strategic plan, that to invest in copper, and but most specifically, I mean, I will have some from time to time on copper futures, but I would like to mostly do it through the companies, that mining companies, and the best one for me is FCX, Freeport. But there are other ways to get exposure to copper. The point is that copper is, if you want to have that economic growth, if you want to have that energy transition, if you want to have that digital wave, all of these, none of these can be done without the role of copper. And the thing about copper is that the yield is dropping in terms of copper, meaning that they're not enough companies mining enough coppers, right? So that's, at some point, it's going to put some pressure on the supply, which again, it's beneficial to whoever is investing in copper. Now let me show you another chart. I'd like to direct your attention to this two parts: primary demand and AET, which stands for accelerated energy transition. And this is, we're generally looking at the mining supply, right? So this is, if we do not go through this trend line, which is the accelerated energy transition, well, we might not, face a copper shortage. But if we do, then look at that. We will face shortages in terms of potential supply, right? So this is another way of saying that, if we believe in that future, then copper is definitely part of that future. All right, moving on to natural gas. And this happened just a few days ago. What this is saying is that the Russian gas transit via Ukraine stopped on 1st of January. So it has already stopped, actually, which, going to create some sort of an energy problem, especially for Europe. And, mostly US, and especially Donald Trump has proposed that, not proposed actually, it's going to be, giving an ultimatum to Europe that, oh, you got to use our LNG, which again, we're not here to talk about the rights and wrongs of the whole thing. We're just here to think, are we able to take advantage of whatever the situation is or not? So I'm pretty sure that the trend is going to be because of the Russia and Ukraine, unless it, by some miracle, it happens and they get some peace. So Europe is going to face a lot of energy problem, a lot of natural gas problem, and we can see that the prices on those are going up. But this is a good opportunity for US and for US based companies, like, for example, Occidental is one of those that I really like. That can, and also another company that the ticker is LNG. Actually, that's interesting. That they provide a lot of natural gas. So generally, in terms of U.S. and this, I'm not really optimistic in terms of the oil and the use of fossil fuels for the future, and I think that's still going to be trending down. But over the next year, again, this is one of those tactical views. Over the next 3, 4 months, 6 months, I think they are going to be benefiting from this trend. And not only that, we have already talked about this drill baby drill policy of Donald Trump, which you know, I think it's like I said, most of the companies, the amount that they produce in terms of the oil, and it really depends on the price of the commodity that they're producing, right? So now we are talking about oil. Now if the price of oil drops below a certain number, then it's not really profitable for them to to do any drilling, right? So, but again, it could have a very good effect on the infrastructure, pipelines, MLPs, right? Those are the areas that I am more interested in. Oil services are the parts that I'm interested in, and this is the ETF for the energy XLE. And here, like I said, there are most of the big companies like Exxon, Chevron, Occidental. These are the big companies that they have different divisions. They have gas divisions, they have petroleum. So all of these companies as a whole can benefit from this trend and the whole Europe energy crisis that is going to happen. So they can benefit from that. And but generally, if you think about the oil prices, the one thing that can really boost, not even oil, the whole commodities as a whole, one thing that can really boost the price of commodities as a whole is China. So, and China, we know that they have been, under, you can say, recession for the past year or so. But if that country comes online, because, like I said, that's the biggest factory in the world, and they are the by far the most, they consume the highest amount of commodities. So that country comes online, it doesn't matter what happens in between, there, you will see a rise in commodities as a whole. All right, last but not least, let's talk about gold. Uh, Now, when it comes to gold, gold is more of a psychology investment. Is more of a specul. I can't say speculative, but it's because it's not really used in terms of what do you say, manufacturing or economy. It's mostly for jewelry, and people feel safe when they're holding it in terms of not losing their purchasing power, fighting against inflation, or if, when there is any disability in the war. It's like when there's a war going on, the price of gold normally goes up. So because we are going to have like an unclear picture in terms of what Trump is going to do in terms of inflation, and to be honest, we can see that uh, internationally it's not a pretty picture, although it's getting better. But again, you got Russia and Ukraine, you got Israel, you got Middle East, you got, so having gold in your portfolio, it's always a good idea. But again, it should not be more than a certain percentage of your portfolio. But having like a 5% in your portfolio of gold, depending on the situation, it could go higher, it could go lower, but at least 5% of gold all the time, I think that's a very good idea. Okay, moving on to crypto. and we are going to talk about Bitcoin, Solana, Ripple, XRP, Ethereum. Uh, Now, when we are talking about crypto and Bitcoin specifically, 2024 was one of those years that anything good that could happen happened to Bitcoin, right? So you started the year with the whole issuance of different ETFs, great. Then you had the halving, great. Then this happened. You had Donald Trump talking at the Bitcoin Nashville conference. Now, this was the major event for the Bitcoin, right? So you got the president of the United States talking about and supporting basically Bitcoin, right? Uh, and he made some promises. He talked about the having the Bitcoin reserve, and he talked about removing Gary Gensler, which he did, and it was right now the SEC is run by Paul Atkin, who is someone you know is in favor of Bitcoin, you can say, and there are other things that he said, like, I don't know, eliminating capital gains tax on U.S. issued cryptocurrency, which gave a boost to XRP, Solana, stuff like that. So it was a big deal. But I one thing I should say is that for him, for Donald Trump specifically, he doesn't really care about crypto. He cared about getting elected. So, the people that gave him money, the donors, were the ones that were behind crypto. And he said, yeah, sure, I will come and talk about Bitcoin and say some stuff, stuff. But again, these are the things he cares about himself and his family businesses. And yeah, him and his son, they're running a company that they have their own token and stuff. And, out of nowhere, capital gains eliminating capital gains tax on US issued cryptocurrencies. I mean, who is that going to benefit? So again, with Trump, and not only with Trump, one thing that I hate to break it to you, if you don't already know, politicians lie a lot. So we got to wait and see how many of these things that he has said will do. But for now, the hype is there. Oh boy, the hype is there. And you can see that in the price of Bitcoin. And this was November 4th, November 5th, something like that. Then, woohoo, you had the run. And, this was the tweet from Donald Trump. Congratulations, Bitcoiners, 100,000, you are welcome. And see, again, that's the kind of person he is. He has to take credit for everything. So when Bitcoin hit 100,000, he was like, okay, yeah. I mean, in this case, maybe he's not wrong. It actually, this whole thing happened because of him. But we will see. We will see how it evolves. And again, the price is different right now. It was at the time that I took the screenshot, but we'll go through some other screenshots that the price is different because, the price moves. So we don't know. Anyway, this whole hype actually went into other part of the crypto market as well. And interestingly, if you look at this chart, the winner after the election of Donald Trump was not Bitcoin, it was not Ethereum, it was Doge and XRP. And Doge, well, the only reason I think Doge went up was that because Department of Government Efficiency. That's the thing that Elon Musk and Vivek Ramaswamy is going to run, and because that's spelled out Doge, well, Doge also went up. So, these are the things that you see in this environment that it unleashes a lot of things that a lot of animal spirit in the making. And this is the smallest part of the whole animal spirit. this whole thing gave birth to lots of other things. And one of the interesting things that it gave birth to was the Haktua coin. So remember that Haley Welch, that girl, the Haktua girl, he came up with the coin, and the coin crashed and stuff like that. So that's the kind of environment we live in. And not only that, we had that guy with the banana, the $6.2 million banana. And the interesting thing about this is that this guy, the banana that was taped to the wall, they change that banana every so often, because it would get spoiled. And uh, the banana that he ended up buying was actually bought from this guy on just some street corner. So when they told him that the banana that you sold to that guy, and then that banana was eventually sold for 6.2 million, how do you think this guy felt? Anyway, but forget about Doge, forget about Haktua, forget about this banana thing. The thing that blew my mind, that came out of this hype, was the birth of something called fart coin. In case you might think that you heard me wrong, look at this fart coin. Just imagine typing fart coin as a, in code to get a code. Just imagine. Anyway, but so there we are. We have fart coin, and this is not the interest. The interesting part is that the market cap of this thing is more than 40% of all publicly listed companies in the US. Just just think about that for a second. Well, we have had hypes like this before, like in the Corona time and dot-com bubbles and stuff. I'm not saying you know economy as a whole in a bubble. No, no, no. But there are parts of the market that is in the bubble, and whenever stuff like this happens, it it rarely ends well. So just saying. Anyway, getting back to Bitcoin. Now, one thing that is, kind of a good thing actually for Bitcoin is that its volatility has reduced quite dramatically compared to the previous cycles. So, as you can see, this is the latest cycle, that the volatility of it is around 25% or so. And we have had volatilities of in around 80, 75%, 80%. So this is actually a good news. Well, you can say a good news and a bad news at the same time, because when the volatility drops, the expectation for higher prices also, drops. So we'll see, because we know that most people that are in crypto and Bitcoin, they're in there to get that huge move and for Bitcoin to be their lottery ticket. So we'll see. Now, another thing that I found interesting is that because of that same volatility scenario that we saw, was that the CAGR, the compounded annual growth of this cycle, is also a lot lower compared to the other cycle, which is understandable, seeing that the volatility is changing. But these are the things that are you will see in an asset class when the asset is maturing, which is a good thing. If Bitcoin wants to be accepted as a respectable asset class, it has to be it has to lower its volatility. And but again, it's a double-edged sword, because we don't know if the crowd that is behind crypto will like that and will stay in the crypto market if that volatility drops. We'll see, because we know that when it comes to Bitcoin, uh, I mean, the environment that we have, if you're not in Bitcoin, then you're doing something wrong. But I've said this many times before: if Bitcoin goes away tomorrow, nothing will change, right? I mean, it has so far, maybe it will in the future, I don't know. So far, it has no utility, right? And most people that are chasing any of the crypto things are because of that volatility, because of that price hike. So that's something that remains to be seen. But for now, everything is going for it. And not being in that asset class is not a good idea. But as I've said this before, you know, you gotta you have to have a holistic view regarding your portfolio. So Bitcoin also has to be part of your portfolio. I do not advocate for Bitcoin to be all of your portfolio, at least for now. Anyway, now this is also I found very interesting, which is some on-chain data for the short-term holders, and this is called CBD, these cost basis uh, distribution, which is around the 86, 87,000 mark, and we can see a strong, as we can see here, strong accumulation at about 98,000 K. And we see a lot of the lower bound of it is around 86 or so right now. The problem with that is that, and that's why if you do not own Bitcoin, I think getting in that level is a good thing, like around 88, 87 mark, because if you take a look at this cost basis also scenario, which lines up with that, and we will take a look at some charts later on, some technical analysis, but for now let's finish up with this chain analysis. And another thing that you see here that kind of worries you is that there is just air gap between the 88 and 70. So if you break that CBD, that cost basis distribution channel, then there is nothing stopping you until you get to the 70K, which again, for the environment that we have right now, I think these are all good levels to get some exposure. If you don't have exposure, that is definitely a good level to start your exposure. If you have already an exposure, then maybe you can add a little to it. All right. Now, another thing that is widely discussed when it comes to Bitcoin is that the price of Bitcoin follows something called the power law, right? And I'm not going to get into the whole power law and how it works right now. Maybe another video. But and this is a log chart basically, because the price at the earlier cycle is were too small, and then jumps were too huge that if you use a normal chart you can't see those prices, so you got to use a log chart to be able to see that. But anyway, in terms of the power law, if we believe that the whole network hashing, the number of addresses, everything that follows the power law model, that power law suggests that the Bitcoin price should be around 83,000. So again, these are models, but if enough people are looking at that model, then maybe you can use it to, again, use it as a support to add some exposure. All right. Now this is another chart with some other levels, and this is the more up-to-date price. And these are mostly based on some Fibonacci levels that I've drawn that also can act like a guide. But again, the most important part is that from here to here, we have air gap. So watch this. If this breaks, then, here would most likely land somewhere here. All right. And in terms of the moving averages, we have the 50 moving average, 50 SMA is at about 96, the 20 SMA is about 97, and the 200, which is the important one, is at about 70K. Okay, 71K, which kind of adds up with the whole levels that we saw before, which could act as a strong support. But in terms of the the stochastic oscillators and the MACD, we don't see much. We don't see a good signal here. But I think it's better to watch those levels than to go through the MACD or stochastic. But in terms of RSI, we are on a reasonable level. We are right around 50. That's good. Now, to finish up this crypto section of the talk, we got to take a look at some net flows, fund flows into ETFs, into specifically the BlackRock ETF. And we see that recently we saw the biggest net outflow from the ETF, around 300 something, 330 million of outflow, which was, the biggest so far. And I don't read too much into it because, generally beginning of the year, end of the year, you do a lot of rebalancing. So, again, something to watch if it continues, the number of outflows. But, for now, I don't read too much into it. I will take it as something that is an end of the year scenario. But in terms of Ethereum, this is very encouraging in terms of Ethereum. Ethereum, I think, because the price of Bitcoin is becoming more and more expensive, obviously, as it's going up, the other coins are going to get more attraction. Like I said, and also if that tax exemption for capital gain for U.S. issued cryptos also goes into effect, then you're gonna see a lot of more positive reactions from XRP to Solana, and in terms of the lower price ETFs like you know Ethereum. Although the price of ETF somehow solves that expensive Bitcoin issue thing, but again, I think those will have their day also in the next year. And also, one more thing, one big thing that happened this year that we didn't talk about it was MicroStrategy, Michael Saylor, right? And issuing loads and loads of convertible debt and also issuing shares to go into the market and buy those Bitcoins. Not only that, we also have a lot of miners. So the other things that are affecting Bitcoin is MSTR, which is MicroStrategy, and a lot of miners. Miners are also, using the same strategy as Michael Saylor, and they are issuing a lot of convertible debt to go and buy Bitcoin. For miners, they don't have to go buy; they just mine it and they just keep it on their balance sheet, and they are taking advantage of this thing. And one thing you should remember regarding the let me bring back the chart. One thing you should remember regarding the moves that you see in Bitcoin. Crypto in general still is a thin market. If you're thinking about crypto as a whole, I think we are about 4 trillion, something like that, which is the size of, I don't know, one Apple company. So it's not that big. And because it's not that big, when we're talking about Bitcoin itself, it's a lot lower. So when we're talking about crypto in general, moving that market, when you see Michael Saylor goes and issues 2 billion, 4 billion of convertible debt, and comes in and buys Bitcoin, that can easily move the price, right? And we can see there's a lot of evidence that most of this move that we have seen recently is because of one or two guys that are just buying the Bitcoins. And the question is, what happens when that stops? Are there enough people, enough corporations that are going to fill in the gap or not? So that's the biggest question that is facing you in terms of Bitcoin in the future. But again, I think with all the things that is going for it for now, that's a good place to be. That's a good place to have some exposure. But again, just like gold, I believe that it should be part of your portfolio. Those 10-year yield are going to have some effects on these as well, just like everything else, every risk asset. So I think having like a 2 to 5% weighting in your portfolio makes sense. All right. Lastly, we're going to talk about China, and I'm not going to spend that much time here, uh, because it's a sort of a contrarian take, and most people are not very comfortable with China right now for good reasons, I might add. But there are a lot of policies, and we're not going to go through all of them right now. These are the lists of policies. You can read it later. These are the lists of policies that that have been have been said by the government of China that they are going to do in order to support their market, from monetary policy easing to the stock market support. And one thing that is really interesting in terms of stock market support is that they are actually going to loan you money to go and buy back some of your stocks. So we have to wait and see how the trade war is going to affect the relationship between U.S. and China, and how are they going to support their markets. So let's take a look at this. This is the GDP annual growth rate in China, right? And you can see it has averaged around 5%, around 5%, right? So my whole thing is that with China's leaders behind the economy and trying to give stimulus to the economy, putting a lot of incentive, and with a country that has a GDP of that level, that's something that you cannot ignore. So having positions in Chinese stock, especially Chinese tech stock, I think is a reasonable thing to do. Now, the thing that is troubling for China is the 2-year bond. That look at this trend, which is the kind of a mirror image of the U.S. And that's the risk that you have. That those policies are going to work. I mean, market is not very optimistic. That's why you get a yield like that, right? Now, in terms of the stock market, also, you don't have a pretty picture there either. But I think that's we are reaching good levels in terms of investment. And like I said, uh, like any other segments that I talked about, I use ETF to give a sense of the overall market, but I prefer single stocks like Alibaba is a good one, Baidu is a good one. So these are the areas that I like to have exposure on, because I know that there is something that is coming to save that market. And again, with GDP with that level, with with the government saying that kind of support they're going to put behind the country, and frankly, these companies are profitable companies, right? So they are going down because of the vibe that is surrounding that market. So again, I think in terms of risk to reward, something that I've said all the time, in terms of risk to reward, it makes sense to have some exposure in China as well. All right. With that, we are done with this presentation. Good luck.